Welcome to the Director's Cut for October 2020, where we have August production information. Justin Kringstad will be joining us virtually, so if there are any issues with audio or visual, please just put something into the Q&A. That will help make sure that I'm aware that there's something going on, and we'll make sure to get that adjusted for everybody. Otherwise, I will let Lynn get started.
Good afternoon. Thanks to those that attended and those that have tuned in virtually over the web. It's nice to talk to you again. This is our October Director's Cut, so we are talking about August production, back when the weather was warm. It's nice to note that we are back on the road again to healthy production. So we'll start with that. We'll start with oil production, up 122,000 barrels a day, a 12% increase. So that's on top of a 16.5% increase last month, which puts us back close to the 1.2 million. I think the current revenue forecast is using 1.25, so we're knocking on that door, and that's good news. When we move down and we start talking about crude oil prices, not such great news. It's not terrible, but crude oil prices have really struggled to stay above $40 a barrel. I think some of the recent strength that we saw, like last week, was in large part due to the Gulf of Mexico shut-ins from Hurricane Delta. And so you can see that today WTI is at $40.96. That's a healthy price in terms of returning wells to production, but it is not really close to sufficient in terms of completing wells that have been drilled but left uncompleted, what we call DUC wells. We need to get above $45 for that to be seriously considered. And so most of the operators are looking at a June, July timeframe when they would start to look at non-completed or DUC wells. So $40.96 leaves us $4 short of that minimum threshold for those kind of investments. It leaves us probably $14 short of the minimum for increased drilling activity. Now, we haven't seen a recent, just from last week, we saw a few more rigs added, so we'll talk about that just a little bit when we get down to rigs. But on the oil price front, a real struggle to hold above that $40 level. That's because we still have very large inventories of oil around the world, and demand is so uneven. Interesting, this last week it was reported that gasoline demand has nearly recovered in Europe, in North America, and in Asia. So gasoline demand is looking pretty strong, and it looks like, you know, recovery is going pretty well. Distillates like diesel fuel, not so good, and in fact is lagging pretty significantly. So over the road shipping, construction, agriculture really haven't kicked in, and then jet fuel is still absolutely terrible. And so our refinery infrastructure is designed around a certain blend of those things coming out of the refineries. And what I'm hearing is that refineries are having to retool to try to turn jet fuel into distillates for diesel trucks and ag, and retool to produce as much light distillates, gasoline, as possible. So because the recovery is so uneven in those areas, that's also downward pressure on the prices. Natural gas production up substantially, up 327 million a day, which is a 14% increase. So we're back on that track of gas oil ratio increasing. Oil up 12%, natural gas up 14%. The great news is that even with those strong gas numbers, our gas capture looks really good, 92% for the month of August. And so it isn't just a matter of low production resulting in high gas capture, but it actually, we're reaping the benefits of the 2019 roughly $3 billion that was invested, almost $4 billion that was invested in gas capture and natural gas liquids transportation. So that's good news. When we move down to the drilling rigs, I guess we'll talk about drilling rigs. We are up 3 in the oil and gas sector from the 11 that we had, so 16 total. 2 of those are drilling carbon storage. And so, let's see, I guess I must have left, I left a parenthesis out there, which is inaccurate. You can strike that. The slurry fracture injection well has reached TD. So 2 of the wells are drilling carbon storage, 2 of the rigs are drilling carbon storage wells. 14 are drilling oil and gas wells, and that's the best number we've seen since April. What is driving that? Well, what's driving that is the concern about a change in federal administration and federal policies. So everyone who has a federal drilling permit in hand is employing a drilling rig and getting that well drilled while the drilling is good. And so there's some concern about what a change in Congress or a change in administration might mean, and that's stimulating, at least on a temporary basis, some increased drilling. But as I stated before, we're about $14 short price-wise of seeing a real recovery in drilling. And so even though we've got 14 rigs drilling oil and gas wells, we need 30 to 35 in order to stabilize and grow production. So we're well short of that. We're at half of the number that we need or less. When we look at inactive wells or wells, better, we're seeing wells return to production. As I stated when we looked at oil price, the prices justify returning wells to production. And we think we're down in the, maybe down between 1,000 and 1,500 wells curtailed or shut in now as a result of the CARES Act situation. So the amount of production that's shut in is dwindling. It's less than 100,000 barrels a day at this point. In the completion area, we had a good month in July, but a pretty poor month in August. So when we look at completions, we dropped off to only 19, and we need 60 to 70 completions a month. And so 19 represents less than a third of what's needed in order to maintain or grow production. So one of the things that has happened is the Bakken Restart Task Force has submitted a request which will potentially go to the Emergency Commission a week from today to repurpose $16 million from what we're not going to be able to use in reclamation. So as you can tell from the weather outside, the window is beginning to close on reclaiming orphan well sites. We're still looking really good on getting all the wells plugged, but we think we're going to land at somewhere just north of 50% on reclamation, which leaves over $16 million of CARES Act money potentially unspent. So the Restart Task Force came up with an idea of how to repurpose that. And the concept is to offer grants to companies who will complete duct wells between now and the end of the year to pay a portion of their water acquisition and water disposal costs. Several benefits from that. It potentially will put 500 to 1,000 people to work, an additional 5 to 10 frac crews. It will result in the completion of 80 to 100 additional wells between now and the end of the year, and that will yield somewhere between 100 and 200 long-term jobs, people that will work in the producing end of the industry for 30 or 40 years. Those jobs will exist, and it will help stabilize that production number. So the revenues from extraction taxes and production taxes that flow into school and water projects and infrastructure projects can be sustained. So we've submitted that proposal, and we're very hopeful that that'll move forward. We've talked to the companies who do the fracking. They've got the equipment available in North Dakota and say they can get the crews here. So it's just a matter of getting the approval and then getting folks to complete the wells and submit the grant applications. So that's talking about completion. So we're at less than a third of what we need to sustain the kind of production levels that we're seeing. When we look at producing wells, that has improved some from last month. Still 87% are Bakken Three Forks wells. When we look at the Fort Berthold activity, up one drilling rig, up 18,000 barrels a day, and several duck wells have been completed. So the numbers look pretty good there. There's some concerning news out today where the Bureau of Land Management has placed a moratorium on drilling permits that would penetrate the riverbed as it crosses Fort Berthold Reservation because of the riverbed dispute and the litigation that's going on there. And so that's going to slow drilling activity as we move into next year, that moratorium, because those are all going to need a BLM permit if they're going to penetrate riverbed minerals. So that word's just out today, and we'll have to do a little more processing to see what that means for us. Seismic activity has dropped again. The carbon storage projects finished their seismic work. Nothing has really changed in terms of supply-demand balance from the EIA. We're still running well above the 5-year average in terms of oil storage, as you can see, coming down, but still running outside the window. And like I said, a lot of that is the difficulty that the refineries are having balancing out their crude runs and producing something besides jet fuel. And so they're struggling with that. Let's talk about natural gas just a little bit more. Great numbers on the gas capture. So solid across the board, in compliance with the November 1 number, which here in just 2 weeks, the requirement is 91%. And you can see that there's no place in North Dakota in terms of the numbers that when we look at them sort of in large geographic areas, that is not capturing 91%. So there may be individual well pads, a few oil fields that are lagging behind. But as you know, last month, the Industrial Commission tightened up its gas capture policy and intends to keep that tight and maybe review it in a year or two to see how it's working. But that's designed to incentivize increased gas gathering infrastructure. We're still hopeful about a couple of announcements that may come before the end of the year in terms of some new and improved things to do with gas. So we'll see how that goes. I want to close with just one comment. We were extremely pleased with Judge Skavdal's order on the Bureau of Land Management waste preventing, or as we call it, venting and flaring rule. He ruled in favor of the North Dakota, Texas petition and the industry petition that BLM overstepped its bounds, that the Obama era rule is now enjoined and tossed out. So where are we? Well, California tossed out the Trump rule. Wyoming tossed out the Obama rule. So we're back to the offshore order number 4, which was what they did. They managed flaring through pre-Bakken and Three Forks. So I do truly appreciate Judge Skavdal's comment with some humor, and I want to quote this. He says, "So 3.5 years later, after several turns and loop-de-loops, it seems the roller coaster has returned to the station. though the court doubts any of the parties will be exiting the ride just yet, as it is likely this court's decision will not end this ride, but simply serve as a lift hill, transporting it to another level. His comment was that the federal courts and litigation is a terrible way to create policy. It is, we call it the hokey pokey here because the rules go in and the rules come out and they get turned about. And I think his comment is that litigation in the federal courts is not the way to do oil and gas policy. And I would totally agree with Judge Skavdahl. One closing comment, I guess maybe two. The U.S. Forest Service rule revision on oil and gas leasing on the National Forest System is still open for comments. That comment period will close November 2nd. So comments are due soon. And finally, a few people noticed that we didn't do break-even prices last month. Well, in this environment, there is no realistic way to calculate or update break-even prices. So we're going to leave the break-even prices that everybody knew and understood pre-COVID out there, and we're hopeful that maybe as we get into the early part of next year, there will be enough drilling, enough completion activity, enough price stability and market recovery that we can really, talk about real and true break-even prices. So we'll leave it at that, but no intention to update those until we get maybe into the second quarter of next year, because the data is just not there to accurately calculate or predict break-even prices. That's all my comments, Katie. Be happy to take a few questions.
Perfect. Go ahead.
So last time we met, you talked about kind of the summer spike and it was staying into September, but you weren't sure if it was going to taper off come October. Have we seen those production spikes kind of tapering off, or are we going to see that coming within the next few months?
Yeah, so the question was, we talked last month about, hey, we're getting this nice production spike. It's summer. As we move into October, November, what do we think is going to happen? So we do expect our September production to be up yet again, but that likely will be the best that we will see for some time. It's possible we could see a small increase into October, but like I said, the prices that we have are not supportive of well completions, which we really need to drive this thing. They are supportive of return to production, but we've got less than 100,000 barrels a day shut in as we look at the August numbers. So we've just about tapped out the return to production increases that we're going to see, and we don't have the kind of drilling and completion activity that's going to drive the number higher. So still expecting that October will be flat to November at best, and November could start a downward trend in production. Now, if the CARES Act money gets repurposed and we put another 5 to 10 frac crews to work in November and December, we'll be able to actually grow that production through those numbers, and that should give us a nice sustained ramp through the second quarter of next year. So that's the caveat to that. But unless that happens, then starting certainly in November, maybe as early as October, we'll see production start to drop because we don't have drilling and completions driving it. So
then going off of that and talking about the reallocation of this Bakken restart stuff, will you go in depth a little bit about what if you expect the Emergency Commission to pass this, and what kind of conversations you've had that led you to decide this? Great,
yes. So the question was that this repurposing of the CARES Act money, what kind of conversations did we have? So the 1st of October, actually the end of September, we were asked to evaluate whether we were going to be able to spend or all of the CARES Act money that had been allocated, or was there going to be turnback funds? And so we did that evaluation, looked at the number of wells that we could get reclaimed, and determined that there's about 16.9 million that we likely are not going to be able to spend because of the weather window closing on us. So we brought the Bakken Restart Task Force back together. We talked about a few different ideas of how we could ask for that money to be repurposed. We brought up the thief hatch replacement project again, found out really that most of industry already did that. And so there was very limited interest in industry spending money on that because they've already spent the money. We looked at whether some type of COVID testing could be offered to help industry or anything like that. And they pretty much have all those protocols in place. And then I was having a conversation with the governor's natural resource director, and I was preparing for a trip to Williston to talk to the API section up there. And so we discussed with them what area really could use a boost here. Where could we create a lot of jobs quickly? And the comment came back, well, we need to get frac crews in the field. How can we do that? Well, we had a conversation about what we could do to incentivize completion of wells. And turns out that we kind of felt like we hit the sweet spot. We had some conversations about what's taxable, what's not taxable, what is a North Dakota industry, what is an out-of-state industry coming in, what's going to generate sales tax, and we landed on water because that's a North Dakota industry, the production of water and the disposal of water. It's non-taxable, but it's if we stimulate a large number of completions, all of the other inputs to a frac job are taxable. The sand, the gel, the cement, the tubing, all that pays sales tax. And then the frac companies informed us that it would create a lot of jobs, 500 to 1,000 jobs between now and the end of the year. And the operators indicated that they need, between 1 and 2 people per wellhead to long-term produce these wells. So a lot of conversations. We had the Bakken Restart Task Force kind of started it. A couple of us had a conversation and spoke to people at Williston API, and the whole idea just sort of gelled. Yeah.
The whole question on that CARES Act funding. Could you talk a little bit more about what sort of changed from the time that you'd scheduled for those reclamations to be completed this year, and then you said that it'll only be about 50% actually getting reclaimed. What sort of changed in the intervening period that made those wells harder to reclaim?
Yeah, thanks. So the question was, what changed in terms of the CARES Act funding for plugging and reclamation that resulted in 16.9 million of turnback? And I would say the primary thing that changed was how long it took to get the wells bid out and contractors started. So we're at full workforce now, but really only got there as of last week. And so just the whole procurement process and what it took to put those together was one of the biggest issues. The second biggest issue was that a lot of the wells had to go through a legal process, and there were significant numbers of wells that got hung up in the legal process because commission orders to confiscate are appealable, and reconsiderations can be requested, and so a lot of that pushed these confiscations out 6 or 8 weeks, and so we lost a month and a half to 2 months of time because of the the extended legal process, and then the procurement process of getting the contractors on board. So far, we have not run into a situation where we've got such significant contamination that we can't do the reclamation. But like I said, we just really reached full strength last week in terms of the reclamation crews. So that may yet be to come, but it was that legal process and the procurement process that really delayed us, and the weather window closes pretty quickly in North Dakota. So it's unfortunate. However, we do have money that we're going to be able to tap the abandoned well site restoration fund, and also potentially single well bonds that were posted as wells were abandoned. So there will be money to complete the project. It just won't be CARES Act money.
One point of clarification on that. I think you said this, I just want to make sure I'm understanding correctly. So that 16 million in grant funding that would be going, I think, I'm sort of saying stuff back to you here, but I just want to make sure I understand. Mm-hmm. So that 16 million would go back to oil companies as grant funding for them to then reclaim the wells this winter on their own. Am I understanding that correctly?
No, the question was about the 16 million in grants. So it would be repurposed to provide up to $200,000 for every duck well that gets completed between now and midnight December 30th. So this money would be repurposed away from reclamation. We know we have sufficient money to finish the reclamation. It'd be repurposed away from that towards creating jobs in a different sector, which is hydraulic fracturing and completion of wells. So the concept would be that anybody who accelerates the completion of a drilled uncompleted well, say that they were planning to complete it next year, but they're going to complete it now in November or December, they could apply for up to $200,000 and be reimbursed for water acquisition and water disposal costs for accelerating that well completion from, well, like the one I talked to yesterday, the company I talked to yesterday, they were planning 9 wells in June of next year. And they said, well, yeah, we can accelerate those completions into November or December. So that will allow us to stabilize North Dakota's production and get through this biennium with a healthy revenue stream for all the projects that were planned out there. So it's being repurposed as individual grants for completion of duck wells.
And one other question on that. So is there a plan to still reclaim those 50% of wells that will not be reclaimed this year, or is that, so again, this may be redundant, but wondering if those are going to go unreclaimed, or if we're trying to do those when the weather warms up next year?
Yeah, so the question was, what's the plan to reclaim the 50% or so of wells that we won't get to this year? And absolutely, our intention is to reclaim those next summer. So now we don't have the legal process to delay us. We'll still have to go through a bidding process, but the money has been appropriated from bonds that are confiscated and from the abandoned well plugging and restoration fund to do those wells. So sometime late winter, before spring thaw starts to approach, we'll put those out for bids, and our goal is going to be to get those reclaimed. Of course, the best time to reclaim is in the fall, so it may take till well into the fall. Spring is okay. Sometimes it can be pretty muddy. Summer, a lot of times there's cattle grazing and crops growing, and you don't want to disturb all that. So right after harvest, but between harvest and freeze up is the premium time. But our goal would be to have that other 50% reclaimed by the end of harvest season next year. And so, yeah, we have a plan and a schedule in place to do that.
One last. Okay.
So is it fair to say from the September to today, the extra 3 rigs are due to the federal permits and the election coming up?
Yeah, the question was the 3 rig increase. Is it fair to say that that's due to the federal permit concerns? And yeah, absolutely. I affirm that with the operators. That's why they've picked up rigs, is they've got federal permits in hand, and they want to make sure those wells are in the ground.
So then going off of that, the election's coming up very, very soon, probably sooner than a lot of us were expecting it to, because time moves fast. But are they going to get everything they need to get done before the election? And then depending on who's elected, one way or the other, what do you perceive could happen after Election Day?
Yeah, so the question was, what about the time from now to election and then after Election Day? So the really key date is January 17th, when whatever administration is elected takes office. And so depending on what happens the first week of November, we might see some relaxing back to what oil prices would say is the right rig count, or you might actually see some acceleration if there are concerns about a new administration that was less friendly towards drilling to accelerate and drill a lot of wells before Inauguration Day. So it could go either way, and for those reasons. One result in November is likely to result in the rig count dropping back into those, 10 to 15 number because of less concern. The other result, the first week of November, you could see a lot of rigs, a significant increase in order to get wells drilled before January 17th.
And then just to follow up to that, I know we're kind of living in a world of what ifs in this awkward time before the election right now.
Uncertainty is everywhere, isn't it? Yes.
Yeah. So if Biden were to be elected, he's said both yes and no to fracking. So what is your guys' thoughts on that, and what are you going off of?
So the concern and the question was about the Biden administration and the yes and the no to fracking. The concern is that there have been statements out there about no new fracking on public lands. And so because some of our very best rock in the Bakken and Three Forks is unquestionably public lands, it's controlled by the Bureau of Indian Affairs and the Bureau of Land Management. That's been the real focus of these companies. And it's that concern. Less concern, I think, on the fracking end than on no drilling permits, no new drilling permits on public lands. And so I think that's why we're seeing completions pretty flat, but more drilling rigs, because the idea is that you got to get your well drilled, and if you get it drilled, you will be able to frack it. But if you don't get the drilling permit, you can't do either one. So the concern is greater about drilling permits than it is about fracking. And I know the public and a lot of us just sort of lump the two together, but they are separate processes within the BIA and the Bureau of Land Management. And so the concern is about the drilling permits more than about fracking.
I've got one question I'd like to ask that has come in online, and then we'll move over to Justin. Can you maybe talk about completions and just clarify one more time how that number of completions is critical to the production stability? In the past, we've talked about rig count being important, and then as rigs became more efficient, spud per rig was also a very important indicator, and completions, what we're talking about now, and getting completions done. Can you maybe kind of quantify that completions and what that means?
I'll do my best I can with the question. So as this boom began, wells were drilled individually and fracked as soon as you get a completion crew on the well. We began to disconnect that when we went to multi-well pad drilling and batch drilling. So typically today, a drilling rig moves on to a pad and drills 5 or 6 wells at once in a batch process. And then those wells may sit there for a period of time before a completion crew comes. Completion crews have been getting more efficient again here lately, but it's the completion of the well that results in initial production and revenue to the oil company, the mineral owners, and the state. And so we've begun to focus more and more as batch drilling kind of disconnected rig count from well numbers and production. We began to focus more and more on the number of frac crews and the number of completions that are taking place. Unconventional wells like Bakken and Three Forks wells decline very rapidly the first year, 50% typical production drop within that first year. And so in order to sustain production, you need a constant stream of new wells, and to grow production, you really need a significant contribution from new wells every single month. And so we now know with the current efficiencies that we need 60 to 70 new wells in the ground producing every single month just to maintain 1.25 million a day. And less than that, the natural decline will take over. More than that, we can actually push production up. And if you ever let it tip over and really start to decline, it's much harder to reverse that trend and push it back up. A lot like Judge Scavdall's roller coaster. It's harder to turn the corner and get back up that hump. But because these wells decline rapidly their first year, you need a constant stream of new wells replacing that production or adding to that production, and we're well short of that. So we've kind of disconnected the whole business because it's more like manufacturing oil wells. The rig count is less of an indicator than the completion count of where production is going to go.
Thank you. All right, and I believe,
Thanks.
Yeah, Justin, you are on the line. I just want to make sure that we can hear you okay.
Yes, again, everyone, apologize for not being there in person here this afternoon. Katie, if you can go to slide 2, I'll get right into the production update. And Katie, if you can mute any of the phone or the computer microphone, I'm getting a little bit of an echo here. So, but I'll keep plugging away. So on slide 2, just taking a look around the region. So just like North Dakota, increasing its oil production in the months of July and August. We have seen some now numbers from July from eastern Montana, South Dakota, and we've seen production increasing there as well, which is, again, encouraging for the overall production in the region and the transportation dynamics. And so, Katie, if you can go to slide 3. You heard Lynn cover this earlier, very similar type of month-to-month changes, both for crude oil and natural gas to what we saw June to July, and then again July to August. And I would certainly concur with Lynn's comments earlier about what we might be expecting for the months of September and October going forward. So on slide 4, taking a look at what production was remaining shut in the month of August. And so again, comparing the pre-industry slowdown to the August numbers, I was able to identify just over 2,700 wells that were still being flagged as shut in or severely curtailed. The resulting impact of that production from those 2,700 wells is just under 200,000 barrels per day. And so on slide 5, we can really kind of side-to-side comparison of how this discussion surrounding shut-in production has evolved from the May to the August timeframe. And the scales are not identical in each one of those bar charts, but if you look left to right, and if you just focus on the orange segment of this chart, you'll notice that the number of wells that are being flagged as shut in or curtailed continues to march downwards. And so Again, at the peak, over 6,700 wells were flagged, and now in August, just over 2,700. So a substantial decrease in the number of wells. And then on the bottom half of that bar chart is the resulting impact for production. So again, each month to month, that impact has continued to shrink. The interesting thing I thought for the month of August was even the blue segment wells that weren't being flagged as shut in, that impact change from pre-collapse to August, that shrunk from July to August. And so what that's telling me, that again, there was some production, just producer decisions to, again, throttle back production, but still producing at a level that wasn't substantially down, but that at least during the June and July time periods, that there was production that was being choked back a bit, and we started seeing some of that come off between July and August. So in both cases, resulting in higher production levels for the region. On slide 6, again, this is similar to the last several months of just, again, the wells and the production that still is remaining shut in is still largely sourced from the Bakken Three Forks formations, and still relatively newer wells contributing to the amount of production that was still shut in the month of August. On slide 7, now last month I brought up the discussion around some of the concerns that folks were having about gas oil ratios and what was happening when these wells were being brought back online from a gas production standpoint. And so if we just focus on McKenzie County, that's probably the clearest indicator here. And so in March, so pre-shut-in, you can see in blue the average GOR for the wells that were flagged as curtailed. It's just over 3. We saw that GOR decrease when the wells are being brought back online in June. And then the theory was that the wells had enough time to pressure back up, and that gas oil ratio was dropping when these wells had come back online, because again the pressure around the wellbore had been allowed to build up. And the expectation that folks were having is that this likely would be a short-term type scenario, and I think the numbers are starting to show that already. That in McKenzie County, in the month of August, it had already recovered that gas oil ratio that had dropped during the shut-in period, and is now back on the growth trajectory. So on average, the Bakken Three Forks wells, that GOR will increase over time. So it's not a surprise that even from March to August that we did see an increase in GOR. But again, the concerns that folks were having that the GOR was going to be permanently altered, I think that concern is largely getting put to rest with some of the data that we're able to pull out from the numbers now. On slide 8, this is just a quick update of where my forecasted well completions are for a couple different scenarios that you'll see here in my oil and natural gas forecasts later in the production or later in the presentation. On slide 9, now getting into the transportation dynamics for crude oil. Again, just some very minor changes between July and August. We did not have a substantial shift in any one particular category. On slide 10, you can see that, again, just a slight uptick in the utilization of crude by rail from a market share. Pipeline movements were fairly steady from a market share perspective, as well as refining and the barrels being moved north and south across the border. On slide 11, this is just an update on the crude by rail volume estimate. So somewhere now around that 175,000 barrels per day estimated in the month of August to be leaving the region by rail car. On slide 12, taking a look at the destinations estimates. And so July is, again, the most recent data available, and that's indicating that the West Coast, or PAD 5, in the month of July was the dominant destination. Almost 2/3 of the oil leaving North Dakota by rail in July is estimated to be moving to the West Coast. A third, roughly just less than a third, going to the East Coast. And then we have seen in the last couple of months a bit of an uptick in barrels going down to the mid-continent, or likely the Cushing, the Stroud facility at Cushing, Oklahoma. And I think that's fairly interesting. We'll see what happens here in the month of August. Certainly July, there was a lot of turmoil with the Judge Boasberg ruling with Dakota Access and a significant amount of unknowns during that July timeframe about what August would look like, what the subsequent remainder of 2020 might look like. And so I suspect that when we see the August numbers and then potentially the September numbers, that we could see some more shuffling around of where this crude by rail is going. I wouldn't be surprised to see another uptick in some of the Cushing deliveries and possibly even to the Gulf Coast popping back up again. Again, as folks were certainly scrambling to try and find alternative modes of transportation, alternative destinations for unloading. Certainly a lot of those concerns have eased a bit as far as the most immediate term, but some of the long-term concerns obviously are certainly still there. On slide 13, just taking a look at what pricing was doing from the refiners acquisition costs. What are refiners paying on average in the 5 pad regions of the U.S.? And you can see last month I noted just some interesting information or insight surrounding pad 2, the Midwest, and the Gulf Coast. Typically there's a pretty wide delta or spread between those two, and again now in the month of July we saw that being fairly tight between those regions, and so that might also be accounting for some of those increased deliveries to the Cushing, Oklahoma market. They didn't need to send that train even further to the Gulf. They were able to send some of those barrels a shorter distance, lower transportation cost, and still get to a fairly comparable marketplace at Cushing versus the Gulf Coast. Slide 14, just where pricing is today. Again, just fundamentally the WTI Brent spread, the Gulf Cushing spread, some of those are still relatively tight, and so that Cushing market still looks fairly strong and healthy relative to the other major marketplaces. So as barrels are getting marketed from the region, again, that Cushing destination through some more traditional routes may continue to look attractive in the near term. On slide 15, again, no major shifts in what was taking place on the truck movements north and south across the border. On slide 16, again, that encouraging news that you heard from Lynn earlier about flaring on a percentage basis, dropping another percentage point, and you can see that month to month where we saw that shrinkage in the pie here is on that blue segment. So the percent of gas flaring from zero sales wells is what we saw shrink. And slide 17, you can likely see that a little bit more clearly. Down at 2%. That is not the lowest percentage, but one of the lowest percentages that we've had in the region of gas flaring from unconnected facilities. And so that is a testament to what you will see here on slide 18, which is over the last number of months. Again, every month I show this chart and I emphasize the point that it's always a good scenario when that black line is above or very near that red line. You never, it's not a good situation when the red line is exceeding. So over the last several months, the industry, the gas capture, the midstream folks have been connecting more wells to gas gathering and processing facilities than new wells that have been producing natural gas. And so they've been able to catch up on wells that had previously not been connected. And so that was likely the direct link to why we've seen the amount of gas flaring shrink from unconnected facilities. So again, over the last several months, with the lower completion activity, that has given some breathing room and some time for the midstream folks to catch up a bit on the backlog of wells that were waiting to be connected. So very positive information there. Slide 19 is just taking a look at what the EIA has been predicting. Each month they have their short-term energy outlook, and then I couple that with their long-term energy outlook. And you can see that for the remainder of 2020, still just the very low 40s for their price estimate, before in 2021, still forecasting that we start to see some price strengthening by next summer, being in those mid 40s type range. Slide 20, again, just trying to encapsulate the situation surrounding natural gas processing and how North Dakota is positioned, at least in the near term. Again, for the next several years, North Dakota should be in a very good position, having adequate, gas processing in the region. Long term on slide 21, you can see that again, depending upon the rate at which natural gas production rebounds and we continue to see growth in the region, certainly in the next 1 to 2 years, we'll likely have to start seeing some plans coming forward with either expansions or greenfield facilities to address some of the longer term issues. Again, from the time that a gas plant is in service to when all of the upfront work needs to be done, it's typically a several-year process. And so folks certainly are watching the markets, watching the curves of where production is going to be headed so that we can continue to keep North Dakota well positioned to capture this gas and continue to meet the targets set forth by the NDIC. The last thing I'll comment on slide 22, northern border still no decision yet from FERC on the tariff change to implement an 1100 BTU limit on that system. I'm expecting that within the next 2 weeks we will see the decision that FERC will have, certainly before the early part of November. And again, the three likely options would either be an acceptance of the tariff, a rejection, or potentially some type of additional hearing process that they could choose that route as well. So certainly I don't have a crystal ball of what that's going to look like, but we're still holding tight, and once that information becomes available, I'll certainly make sure everyone's caught up with what the decision was and how that decision will potentially impact the region and the pipeline dynamics here in North Dakota. So with that, I'd be glad to answer any questions from the room or online.
Any questions here in the room? Can you hear me?
I can hear you, yes.
Okay. My question is regarding the DAPL hearings that are happening right now. There's a public comment period that the Army Corps of Engineers is having right now. They're just trying to get some information on whether they're going to grant that easement to Dakota Access. What happens if that isn't granted, and what moves forward if it is?
So the question of what happens with the EIS process. So the Corps of Engineers, the easement that was granted, they have that power to make the decision of whether or not they're going to continue to allow Dakota Access to continue operating. So I don't have a parallel system or past history with any of the other systems where we have something to use as a reference to see what ultimately will play out during various scenarios. This is a bit of uncharted waters, I think, for a lot of folks and how this is going to move forward. So, certainly, whether it's the EIS process, whether it's the court process, through the two court routes that are taking place concurrently with the EIS process, several of those, or all three, present its own set of unique circumstances that would ultimately impact the potential operation of that system going forward.
Any other questions for Justin?
Got one. Hey, Justin, this is Adam with the forum. One other question on Dakota Access. You had sent me a graph, I think either yesterday or earlier in the week, on sort of projected production levels over the next couple of years, depending on the expansion of the Dakota Access Pipeline. On the graph, you note that I guess the revocation of that easement is unlikely in the near term. We're just wondering if you can elaborate a little bit on what you guys are thinking right now in terms of the timing of these court proceedings and whether you'll expect any major developments that would affect operations of the pipeline anytime in the next couple of months.
Yep. So, good question. So, If someone can mute that phone in there, that microphone, that'd be great. Thank you. So in the near term, I'm expecting, at least from the court proceedings, to have some type of next direction, I'll call it, either late this year, the first part of next year. So I think for the next 2 to 3 months, I expect things to continue to operate similar to how they have been. Even with the Corps of Engineers, their process, I'm not expecting in the most immediate near term some type of shift in the way that the Corps of Engineers is directing operation of that system. So I think that as we look forward into 2021, that we'll have more clarity of what the legal proceedings will be. We'll have some more clarity of the Corps of Engineers decision of continuing to allow them to operate during the full EIS study. So once those answers are out, we'll have a better sense of what 2021 will look at. But for the remainder of 2020, I'm fairly confident that the system will continue operating as it has been.
All right, I think we're in good shape, Justin. Thank you for joining us virtually. And for those who are joining the Director's Cut, we will see you virtually again, I guess, in November. All right, thank you.
Great, thanks, Katie. Yep.